Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. In this podcast, we'll provide advice on how you can achieve better outcomes by maximizing investments and minimizing taxes. Let's put our thinking caps on as we consciously decide to get smarter about our money. What are you doing in your portfolio to take advantage of factor investing? Factor investing has been around for some time. It was actually pioneered by Eugene Fama and Kenneth French, originally with their so-called three-factor model, where they were looking at stocks and bonds, value versus growth in small companies versus large companies. They've been adding to it since, and they've added other factors as well. But the important thing that you need to understand as an investor is that risk and return are related. And the general assumption of any kind of factor investing is that you can get a higher return if and only if you're prepared to accept a higher amount of risk. That allows people some flexibility and ability to express a sentiment based on their view of things. So that if you think I can take more risk than the market, then you can dial risk up by tilting toward those factors that should be, in theory at least, be offering a better risk-adjusted return so that you could still build a balanced portfolio with whatever asset classes you want, but maybe have more of a tilt toward those factors that you think will pay you off down the road. This is the sort of thing that is a wonderful example of the headway that's been made in the past generation or so in the investing industry. It used to be that your decision was made simply on the basis of, I'm going to hire someone and that person's going to pick some stocks for me. And I hope he knows what he's doing and we'll see how things go. And a lot of it was really voodoo and not really based on any kind of theoretical underpinning. It was oftentimes based on the idea of a generation or two ago, the broker who was doing the buying and selling on your behalf knew just a little bit more about what was going on in the market than you did. And as a result was a necessary intermediary who could theoretically at least add some value because of his or her insight and access to information. Now that information is pretty much ubiquitous, there's not a lot to be gained by trying to outsmart the market or out trade someone else with regard to what you're doing as a value proposition. There is, however, something that you can do to add value if you are shrewd about it, and that is tilting toward a factor. As we talked about with Trevor Cummings this past week, the main paradigm for maybe 3/4 of a century was one of stock picking. And then for the past quarter of a century, I think it's fair to say that in the 2000s and perhaps even in the late 1990s, indexing had become a more prevalent paradigm that a lot of people were using, and it continues to grow in prevalence. But in the past little while, I'm going to say in the past 15 or so years, people have been more granular and they've been more willing to express their sentiment, not by picking stocks and not by buying the market, by doing something rather that's in between, which is buying with a tilt toward factors or multiple tilts toward factors. And you can mix and match. So one of the things that was talked about was you can say, I believe the Canadian market is fair and I want to keep my costs low. So I'm going to buy an ETF that tracks the Canadian stock market for 5 or 6 basis points, keep my costs really low. Meanwhile, you can simultaneously be of the opinion that the U.S. stock market is expensive. And so you don't want to buy the broad market at a low cost beta sort of approach. Rather, you will take a value approach and you will buy, or a low vol approach, and you will buy the cheaper stocks that are part of the market because you're worried about how, for instance, the Magnificent Seven are very expensive, trading at 60, 70, 80 times earnings and very much priced to perfection. And there's a lot more that can go wrong that can go right. This way, you can still participate in the Canadian market and the US market at whatever proportion you want, even if you think the Canadian market is fairly priced while the US market is excessively priced. You can decide how much you want to dial it up and dial it down. And just as you would have an asset allocation between stocks and bonds and cash and real estate and various other things, you can also have an allocation between active and passive and various factors, or not. But you've got the option, and it's important for you when you make your investment decisions to realize that you have a choice.
John DeGuy is a portfolio manager with Design Securities in Toronto. The views expressed in this program are not to be construed as specific advice. it is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647 Stand Up. That's 647 782 6387 or at jdegui@designedsecurities.ca.